The first signal did not come with a crash. It came with a line item. $17 billion drawn quietly from the Federal Reserve's emergency window. Not in a panic, not during a holiday weekend, but midweek, during normal hours, while markets pretended nothing had happened. No headlines lingered, no anchors slowed their cadence. Liquidity, they said, was ample, yet the borrowing was real, and it was immediate. Banks that had sworn they were insulated, hedged, fortified, reached for the lender of last resort as if by reflex. This is how endings begin now, not with sirens, but with accounting entries. History has already shown the pattern. In 1933, the system failed loudly and responded with force. Gold was declared contraband to private citizens. Ownership criminalized overnight, freedom exchanged for stability by decree. In 1971, the failure was quieter. The gold window closed on a Sunday evening, and money became memory-backed, not asset-backed. In 2008, the failure was technical. Balance sheets dissolved, derivatives detonated, and the public was told it was all too complex to explain. Each time, the mechanism evolved. Each time, control increased. Each time, recovery was declared. This time, there is no declaration, only drawdowns. The silver market is where the fracture became visible, not to the public, but to the clearing desks. For decades, silver existed more on screens than in vaults. Paper claims, layered on paper claims, rehypothecated, netted, offset, rolled forward. The same ounce promised to dozens of owners, none of whom intended to take delivery, until suddenly some did. Industrial demand tightened. Eastern buyers stopped accepting cash settlement. Physical bars began moving east and not returning. The shorts, concentrated and protected by rule books written for calmer eras, found themselves exposed not to price, but to absence. You cannot roll what cannot be found. The response was procedural. Margin requirements adjusted after hours. Settlement windows reinterpreted. Trading halts appeared without urgency, framed as prudence. This has always been the language of control. Orderly markets, temporary measures, technical adjustments. Yet every change moved in one direction only, away from freedom of exit and toward enforced participation. Paper silver continued trading. Physical silver disappeared. The spread between them widened, then normalized on screens while remaining broken in reality. This is the manipulation that no longer hides. Not suppression of price, but substitution of substance. Banks felt it immediately because banks are the counterparty to everything. They clear, they settle, they warehouse risk that is said to be diversified, but is always concentrated. When silver shorts began to fail, it was not the metal that mattered. It was the collateral chain. Derivatives tied to commodities are pledged against treasuries, which are pledged against reserves, which are pledged against confidence. When one link weakens, liquidity must be injected to preserve the illusion of continuity. Hence the 17 billion. Not stimulus, not rescue. Lubrication applied where friction threatened to reveal heat. The fragility of the banking system has never been about solvency. It has always been about trust velocity. Banks do not hold your money. They hold a promise that the system will remain open tomorrow. That promise depends on rules staying stable long enough for obligations to be rolled forward. But rules are changing now in real time. Trading halts no longer require volatility. They require inconvenience. Settlement can be delayed, cash substituted, access restricted, all without declaring an emergency. Confiscation no longer arrives with soldiers. It arrives with updated terms of service. Monetary debasement is no longer a policy debate. It is an operating condition. Currency units are created not to expand growth, but to prevent contraction from being visible. Every new dollar is an admission that the previous one failed to hold value. Yet the language remains optimistic. Inflation is transitory. Liquidity is supportive. Consumers are resilient. This is not deception. It is insulation. Mainstream media functions now as soundproofing, absorbing shock so the structure can continue to sway without collapsing in view. What cannot recover this time is the anchor. In previous cycles, there was always an external reference. Gold before 1971. Productivity narratives after, demographics, globalization, technological optimism. Now the anchor is gone. The East has noticed. While Western systems expand balance sheets and redefine assets, Eastern systems accumulate what does not require permission. Gold moves quietly, silver flows industrially. Energy contracts settle outside traditional clearinghouses. Trade routes realign without press conferences. Power shifts do not announce themselves. They are felt when rules stop applying equally. The East versus West divide is not ideological. It is structural. One side consumes confidence. The other accumulates leverage-free assets. One side manages decline through financialization. The other manages ascent through material control. This is why physical versus paper matters now. Paper is governance. Physical is sovereignty. When shortages appear, paper markets change rules. When physical markets tighten, they simply stop offering supply. This asymmetry is fatal to systems built on abstraction. Loss of financial freedom does not arrive as poverty. It arrives as conditional access. Accounts remain visible but limited. Transfers require justification. Withdrawals are delayed for your protection. Assets are marked to models, not markets. Taxes adjust automatically. Fees increase quietly. Nothing is taken outright. Everything is managed. You still own what you own until ownership is redefined. This is the confiscation through control that replaces force. It is cleaner, it is legal, it is permanent. The 17 billion is not the number to watch. It is the behavior it represents. Banks tapping the Fed during calm conditions signal that internal funding markets are no longer trusted, even by participants. They borrow, not because they must, but because they can, before conditions change. This front-running of stress is rational. It is also contagious. Once one institution secures liquidity, others follow, not to survive collapse, but to avoid being last. This is how silent runs begin, not by depositors, but by institutions. Silver shorts imploding is not a commodity story. It is a revelation that leverage built on assumptions fails when reality asserts itself. The same structure underpins sovereign debt, equity valuations, and pension promises. When physical constraints collide with paper expectations, the paper yields or the system fractures. This time, the system yields. It yields by changing rules, by suspending markets, by redefining fairness. Recovery is impossible because recovery would require reversing these changes. Control, once centralized, is never relinquished. Personal risk is no longer hypothetical. It is embedded in access. Your savings exist within a system that prioritizes continuity over consent. Your accounts are nodes, not vaults. Your ability to transact depends on compliance with evolving frameworks that are never debated publicly. This is not advice, only observation. The system does not need your agreement. It needs your inertia. The ending does not come with a crash. It comes with normalization. 17 billion becomes routine. Trading halts become expected. Physical shortages become irrelevant to paper prices. Freedom becomes a nostalgic concept, referenced but not operational. The collapse is not a moment. It is a process. It is already underway, quietly, efficiently, and without reversal.